The broader energy space has recently been outperforming, however, with the sector leading the S&P 500 over the past month as crude and natural gas prices try to regain some momentum. Joining us now is BofA Securities Head of Global Commodities Research, Francisco Blanch. Francisco, good to have you with us.
Hey, Mike. Thanks for having me.
Sure. Now, I guess the first step is, what do you think has crude prices firming up recently in terms of the macro, and then also just what might be happening on the supply-demand front?
Look, I think we've had two main forces diverging over the course of the last 6 months. On the one hand, we've had the Fed tightening monetary policy. On the other, we've had OPEC essentially curtailing supply, which is a very different macro cycle compared to what we normally have. Historically, oil prices, when they started to come down and crashed, the Fed would cut rates and OPEC would cut production, and we would see a trend emerging from that. It's been a different cycle. The Fed's been hiking, and OPEC has been cutting production preemptively. So we've ended up with, if you like, the two main rowers of this boat going in different directions. So the boat has been kind of spinning, and oil has been range-bound for much of the last year. So that's been one factor. Peak rates, I think, has been a factor that has encouraged asset allocators to come back into the market. Second factor has been Russia. Russia, which for much of the past 9 months has been maximizing export volumes and really and doing a little bit of what Saudi Arabia was doing, cutting back supplies, has actually realigned itself with OPEC+. So now we're seeing peak rates and lower Russian volumes finally starting to bring people back into the market, and you see it really very much so in the price of Russian oil, which has gone up already $13, $14 above the actual price cap set out by the U.S. and Europe.
Interesting. And where do you think that takes us in terms of, where Brent prices might get to this year?
So I think we have a little more upside. We're looking for $90 a barrel average for next year, so heading into year-end and 24. I think one big factor that could push us higher, of course, is China. That's perhaps another big driver of this market. Again, we talk about rates, talk about Saudi Arabian cuts, we talked about Russia cuts. But the real issue, I think, what is China going to do stimulus-wise? We saw them falling into deflation this week. So will we see a bad bank emerging to take care of all those real estate assets that are underwater? Will the Chinese government stimulate the economy more aggressively? I think that could take us a lot higher than $90 a barrel if we start to see that. On the flip side, the Saudis could unwind the so-called lollipop cut, which so far has been extended a couple of times if prices do shoot up over 90. So I think those are the balancing items there. I think the messaging from Saudi Arabia this week has been more on the constructive side than not. So I think we'll probably end up maybe overshooting a little bit before some of those cuts are reversed. And definitely, I think we're all watching China to see what comes out from a stimulus perspective.
And then just to get you to hit on natural gas as well, I mean, obviously it has a lot of momentum in the short term. If you look at a longer term chart, these are not necessarily alarming absolute price levels. Is it just a weather effect? Is there other supply issues we're concerned about again in Europe?
There's a bit of both, Mike. There's the element of weather. We've had extreme heat. And we've been saying for a while, these extreme weather events are going to lead to extreme energy price movements. And we're starting to see that in the global gas market, to some extent in the U.S. a bit less so, to be honest. But then the other issue is if you lose supply in gas, you're going to have a very tight European gas market. So TTF, the European benchmark, was up 30-40% for the last couple of days. And a lot of it's been driven by supply losses in potential losses in Australia, but also the fact that we've seen the emergence of a global gas price floor very much driven by China. China, again, moved away from the gas market last year when prices spiked globally, but it's come back in as prices reverted and came down 90%. So the Chinese are buying $8, $9, $10 per MMBTU gas. Is an attractive gas for China, even though it's very expensive for North America. Remember, they don't have shale. They have to import a lot. So to me, that's kind of the price floor. And the U.S. Henry Hub price will ultimately be also connected to the global gas export market through the liquid natural gas LNG export channels. So those are the main drivers. I do expect stronger gas prices next year for sure. There is going to be more LNG exports, and the market will take it at these price points.
All right, we look for that. Francisco, appreciate it. Thank you.